Morning, everybody. Welcome back to the Opportunistic Trader. It's just after 10 a.m. on December 7th, and we're joined by Tony Greer of TG Macro. How's it going this morning, Tony?
Hey, happy Friday, Mike. How you doing?
I'm good. I'm good. We've had a lot of activity this week. We've been all over the place in all asset classes. Volatility was trading up well above 24 yesterday. We're above 20 right now. We've had some huge ranges on the week in all asset classes. What are you thinking here?
It feels like the natural path of the market is for higher interest rates and a lower stock market to me. That yesterday there was an obvious sort of stick save at 3 o'clock by the Fed on a market that was getting, beat up really good for the second day in a row. We had two consecutive big tick index prints, very close to negative 1500, which shows pretty extreme selling. And then all of a sudden, out of the blue, the Fed has got this softer posture, about being data dependent in that journal article. And it seems like it's just coincidental with everybody in the world pointing out the fact that there's this little inversion in the yield curve. And when there's an inversion in the yield curve, and that's sort of sending the signal that the Fed is going to have to start easing sooner than they are scheduled to. Like they're scheduled to continue to hike rates next year, and the sort of interest rate markets are starting to predict that they're going to be cutting rates next year. If you ask me, I think that whole notion is absurd. I still think the U.S. economy is on a pretty good track. I still think the path of rates is higher, and I think a lot of this market is reflecting sort of the what went on in the oil market, and they're sort of thinking that the whole risk complex is getting shaken up. So we'll see what happens. I think the stock market can go lower. I feel like the bond market should go lower, and that we can continue with higher rates. But it's going to be a really, really volatile trip, man. We're in a higher vol regime, and the market keeps proving that to us.
Yeah, so sticking with interest rates here, how would you play that? Based on this, we've had a big move in rates this week. The 10-year, 30-year, 2-year. Where would you look for an opportunity in fixed income at this point? It sounds like you think rates are going higher.
Yeah, I mean, you can try shorting bonds is really what I'm looking at. You know what I mean? It's the 10-year notes, March of 2019 10-year notes is the way to trade that. Um, I'm just looking for a bet really that, I think that yields in the 30-year backed really off to a really attractive level. Literally backed off 30-year yields, backed off to the exact uptrend line that they've been following down here at 310, and they bounced off of that. But it was a really, really quick descent in yields, from 330 to 310 in the long end. That's a huge move. In the 10-year, we saw them pull back from 325 to 282 or so. Another huge move, but I still think that this is where you can dig in and short bonds here.
I know you moving on to equities. I know you take a look at technical analysis, moving averages, a lot of different indicators, and the past 6 or 7 days in the equity market has been volatile to say the least. We've traded down to 26.20, up as high as 28.14. What based just purely technically, what how does it look, and what would you how would you position yourself?
In the VIX?
No, equities, S&P. I'm looking at.
You talk. Oh, okay. I'm sorry. I didn't hear you. I didn't hear the numbers that you were saying, so I couldn't tell. In the S&P, we're clearly defining this range right now. With a triple top at 28 and a quarter and a triple bottom just
Right.
2600. The more violently we trade back and forth in that range, I sort of think it sends the message that your money is not being treated very well in the equity market, and that you should be out of it. So I don't think of I don't think of this range being traded. The 2600 to 28 and a quarter range has traded back and forth 4 times already, this week. And to me, that's sort of, that volatility is just fatiguing people's money, and, they're fatiguing their long equity view. So I got a feeling that at some point we're going to see a much more serious capitulation than the last 2 tick index days, and that eventually we break down through the 2600 low. You know what I mean? A lot of it is based on the fact that FANG can still go. FANG has demonstrated the absurd ability to go down lately. Sentiment has clearly turned. I'm beating the same drum with that argument, but the chart's telling me not to give up with that argument because FANG is curling over below all the moving averages and they're starting to bear down. So if FANG gets repriced, the whole S&P gets repriced, and I feel like a 10% correction from here would be a pretty healthy one. So that's kind of what I'm playing for, to be honest with you, Mike. I'm leaning short home builders, leaning short social media, staying short emerging markets with a strong dollar theme, and it's all working out fine so far.
Let's stick with that home builder thing you just mentioned there. Early in the year, home builders, throughout the whole year, home builders have underperformed, and it really started in January. And, the mantra, a lot of people, and yourself, you've been coming on with us for months, was saying was higher rates is one of the major areas of it. We've seen rates come in significantly, and home builders are still underperforming. So what do you think the story is? Is it deeper than just rates? Is there something else to why home builders and the housing sector is underperforming?
Yeah, I mean, to be honest with you, like I guess broadly speaking, I think there's a cultural problem. Millennials are going to have, they look at the world differently than we do, and they're not as interested in buying and owning a home. Everything seems like, they're happy to be on a sort of rental basis and a little bit more nomadic than we are as a generation. So, I don't know if there's, I think that's leading to this, issue where we're seeing inventories pile up. And so that combination is a little bit of the, I guess the cultural side of the trade. But, the existing home sales, the number we just saw was terrible. We're seeing inventories build up. We're finally seeing that NFIB builder confidence number take a dip because, there's a little bit less visibility for the actual home builders. Toll Brothers just reported a kind of lousy quarter, and it's actually stemmed the slide for the stock. But there really wasn't much good news in that report. So, I'm expecting with the view that yields are still going higher and that the housing market is the epicenter of economic weakness, and really one of the few centers of economic weakness in the U.S. economy. I think that's centrally located. I'm going to still bet that the U.S. economy is pretty strong, that rates are going higher, and that the equity market needs to back off.
Yeah. Well, I just want to give a brief market update here. Since we've been talking, S&P is now lower on the day. We're down 3. Nasdaq's down 45. I think when we went on, S&P was up 6 or 7, and Nasdaq was closer to flat. And as you mentioned, a lot of the FANG names are lower on the day. I'm looking at Google down 1%, and Netflix now down 2.5%. So, we've had such an active week. Take me through, what are you going to look at this weekend? What do you think? So we've already had out of the way, OPEC is now come and gone, non-farm payroll come and gone. But we have a lot of information still out there with China, with Huawei. What are you looking at this weekend?
Yeah, I'm still, I still think that the equity market is in trouble because of, somewhat because of the headlines, and mostly because that we're going higher with interest rates. So, and because sentiment and FANG has changed. So going forward, when you talk about, you jump on and you say, whoa, the S&P is just down on the day here. To me, that's just the market resuming the natural path that it's been in, right? The market is clearly, the S&P is broken down below major moving averages and starting to work its way lower. We're seeing weakness in individual sectors led by small cap, led by technology, led by, you got huge problems in bank names like Goldman Sachs. You got a huge problem in the most popular stock in the most popular sector of the market with Apple, right? So as long as this is going on at what we can possibly look at as a market top with just that unbelievable implosion of volatility as the markets went into new highs, that whole regime has changed. So we've had 2 events in the last week that have tried to relocate the equity market higher, and it's starting to show already that neither of them are going to work.
Right.
The first one was the G20 placebo that they tried to hand out and say, Trump and Xi got along great, and there's a 90-day truce on trade tariffs. I mean, that was total bullshit. That wasn't a written document. And then they get back from the G20, and the U.S. goes and has Canada arrest the Chinese CEO for violating Iran sanctions. So, the whole trade thing is really very much on the front burner. And so it makes it, it's obvious to me that the market fell after that. Yesterday, that whole Fed, operation at 3:00 with the Journal article, and now they're data dependent. And, all of a sudden people are hoping for a rate cut. I mean, that was the biggest bunch of bullshit I ever heard this week. So I'm not at all shocked that the S&P is falling from 2710 to 2680. I'm rather shocked that it's not testing the 2670 low, the intraday low today, and then so that we can make our way back to test the 2620 low tomorrow. Yesterday's 2620 low, at some point soon. But to me, the natural path is I'm sort of looking for this to curl over to go to head to a much lower level. Think 2300, 2500 S&P or something like that for starters, and then we'll see. But
Yeah.
with the volatility and the selling pressure in the tick index, man, I think the writing's on the wall that the equity market's got to give something back.
Well, that would be really interesting. So just kind of putting it out there, if you think we're going that much lower in equities, do you think yields can really go higher if we're going 10, 15% lower in equities?
Yeah, I do. I still think that, the U.S. economy is strong. I don't think that the U.S. economy has to back off or go into a recession for the stock market to turn first and start heading lower.
Mm-hmm.
You know what I mean? I think that we can have a fairly vibrant U.S. economy. I feel like, if the central bankers care about the middle class at all, they'll finally lift rates off the zero boundary and we'll be able to put money in the bank and save again. Right? That's going to be the only thing that's going to be really good for the economy. So, I don't see how higher rates are really squelching economic growth. So I think that economic growth can continue, yields can continue to go higher, and the stock market can continue to work its way lower. I mean, it's been a 10-year run, and we've got a lot of things that are different this time right now. So that's what I'm banking on.
Yeah, it's interesting just on the current events. So far today, we've had a report from a newspaper saying China's mulling how to kind of proceed with this Huawei, how to retaliate, not retaliate, continue with talks. And then twice now, Kudlow and Navarro both been on media today saying that it's two completely separate topics, what's happening with Huawei and what's happening with trade talks, which I find hard to believe, but that'll be interesting to see how that plays out.
Yeah, I mean, I think it is a totally separate issue. I mean, Huawei is violating Iran's sanctions apparently, and they've already been, we've already been looking at that company for selling spyware inside their software. So yeah, the company's breaking rules left and right. The media is trying to make it look like the U.S. is the bad guy for arresting their CEO. Meanwhile, they may have been the company that inserted spyware in God knows how many millions of computers or programs in the country. So Trump is here to protect the place. He's going to continue to do that at every step that he gets. And, I still think that the trade war is whatever at this point, that what's being priced in is that Trump is relocating the global trade patterns. He's taking China out of the center of it. And this is the world adjusting to that. And it's just going to be an unpleasant adjustment because we've had, the free and cheap money section of the market trading is over. So since that over, I'm expecting the market's reaction to be different.
Yeah. Last topic I want to get you on is cannabis. I know you've been all over this sector for months and months now. Current events right now, Cronos is up 24%. There's talks with Altria. Take us through what you know about this Cronos, what you would do here with that and with the entire sector.
Well, Kronos Group, obviously it's a great company for Altria to buy to get their leg up in Canada, where they just legalized it for recreational use. Right, the whole idea has been, what were they waiting for? Right, what is the cigarette maker waiting for? Getting into the cannabis business, which is casually smoked, and what took them for so long, right? So this is one of those things where, when I go around and tell people, in lectures or presentations, telling people about the sector, the only way to trade it, because it's a frontier sector, is to buy the scary dips and invest and position properly and wait for good headlines like these. Unfortunately, this headline is running cannabis sector, right into a wave of selling that's been taking place as everybody lightens up with this big pullback in the S&P. Right. I believe that, funds are long and strong in the cannabis sector. We're all sitting here waiting for the next headline. We're trying to be in the right names and position ourselves in the right places. And it's really difficult when the headlines keep changing. But as long as they do, there's going to be fits and starts in different stocks. And I think that eventually in the 2 to 5 year horizon, it really leads the sort of HMMJ ETF out of this, out of this dip that it's seen here. Let me just call it up so I can speak properly about it. But this HMMJ, this was just a $26 item, in the beginning of October, and now it's a $17 item off of the $15 lows. It's trying to recuperate back up above the descending trend line, which it broke, but it's still, even with the Chronos headline, there's that. We just had the story at that short conference the other day about Afria, that called Afria a totally overvalued stock, and the stock absolutely got walloped, and it really hasn't made its way back. So what you got going on in the sector, while everybody tries to position in the right name, the smart, sharpshooting short sellers are figuring out for us which names are the actual frauds, or at least potential frauds. So now that Afria's got this sort of red scarlet letter on it, that's going to weigh on the sector. And we'll see if the Chronos headlines are going to be strong enough to pull the sector out of this little dip. If not, it's going to go back to another de-risking in the cannabis space, and everything probably consolidates or works its way lower until we see either the stock market recover a little bit or another daisy cutter headline. I think a cosmetics company or Whole Foods is going to come out and buy a cannabis producer next, but I don't know which one. I'm not smart enough to figure that out.
Yeah, absolutely. It does seem like I've seen some more recent news over the past few weeks of different hedge funds coming out with some individual names that they don't like, that they think have been driven up just because they're associated with the word cannabis. But there are definitely some strong players there, and it comes down to just picking the right names. It sounds like, because the sector still, as you see with this pop in Chronos, has a lot of upside with the right names.
Yeah, the biggest name in the group, Canopy Growth, is trying to, is testing its 200-day moving average. It's testing an ascending trend line. It's trading pretty volatile, with all these headlines. But if it shakes out that it winds up holding this dip, and you really need that name to get back on its horse in order for the sector to. So if Canopy holds this sort of 30, 31 level, and I'm talking about CGC, the US ticker, then I think we'll be in good shape. Otherwise, it's going to back all the way off to 20, and the whole sector is going to get relocated lower.
Yeah. All right. Well, hey, thank you very much. That's Tony Greer of TG Macro. You can check out all his information on his site, tgmacro.com. He's got his morning navigator and a few other things as well. A lot of great information, a lot of great analysis as always. Thank you, Tony.
All righty, Mike. Thanks, brother.
Talk to you later.